Company research reports. Question 8. Correct answer, B. The report is concise, just 5 pages long. It comes out after the company's quarterly earnings are announced. It's shared with people who are already familiar with the company. These features align with another report that focuses on giving updates based on fresh information, rather than offering a comprehensive overview. Subsequent report will compare actual results to expectations, interpret changes, update valuations, and risks if necessary. Research report purpose depends on timing, length, and audience familiarity. Initial reports provide foundational analysis, while subsequent reports update information and compare to expectations. A. Incorrect. Detailed sum of the parts valuations should be included in initial, comprehensive reports, not in brief, subsequent updates. C. Incorrect. Pestle analysis is unnecessary for an audience familiar with the company and industry, as it is too broad and evolves slowly. Question 7. Correct answer, B. When a company introduces a new product line, they usually release a quick report soon after. This report is often called a subsequent research report. These reports are tailored for those already familiar with the company, so they skip the introductory details. The main aim is to share the latest insights on how the new information affects our view of the company and its worth. Bringing a big new product line to market is a significant step in our business, and it could really shake up what we expect in terms of revenue, costs, how much we control in the market, and how profitable we are overall. Investors are counting on us to figure out what this means for the company's worth and how it changes. We need to think about how the product launch might change our estimates for how much we'll make, what we'll charge for it, how much we'll keep as profit, how much we'll spend on new things, and how much cash we'll need to keep running. Let's make sure these changes are included in our updated financial forecasts, like our earnings estimates and cash flow projections. A new valuation, along with any changes in rating or target price, will be the most important information for investors to make decisions. The key thing about the next reports is that they'll focus on what's new and different. The analyst's job is to turn those important changes into updated expectations that help investors decide what to do. A. Incorrect. Initial reports provide a detailed breakdown of the business model and sales channels, assuming audience familiarity with the company. C. Incorrect. Industry analysis, including market size and competition, is part of background coverage, not event-driven updates. Question 6. Determining the business model. Correct answer, B. Athos' scaling up fast really hinges on whether a company needs to splash out on big physical stuff to get bigger, or if it can just crank out more without needing a ton of extra cash. Skylink nails this because it doesn't own planes, so it's not stuck with its balance sheet or what it already has in terms of physical stuff. It makes money by helping customers and private jet owners get together. So to grow its revenue and capacity, it mainly needs more people using the platform. The biggest costs are for tech and marketing, which usually grow as the platform gets busier, so it can handle more without getting bogged down. Because it doesn't need a lot of money up front, it can jump on board when demand suddenly goes up. A. Incorrect. Airfleet's aircraft ownership model, with high fixed assets and capital expenditure, struggles to adapt to rapid market changes due to long lead times and substantial capital requirements for fleet capacity expansion. C. Incorrect. JetWorks' MRO business relies on specialized facilities and regulatory certifications, making capacity expansion challenging. Core. Companies with high fixed costs and lots of assets tend to grow more slowly because they need to make big investments that take time to get approved. On the other hand, companies with variable costs, those that use platforms, or those that earn commissions, can grow quickly because they can get resources and capacity from outside. Models that don't need a lot of capital are usually better at growing fast in times of economic ups and downs, or when there's a sudden increase in demand. Companies with lots of assets often have a higher operating leverage and need more to break even. Businesses that need a lot of money upfront might find it tough to quickly adjust to changes in demand. Platforms or online marketplaces can really take off by using assets from other people instead of buying their own. Question 5. Correct answer, B. To figure out a company's business model, it's helpful to look at the information that tells us how the company makes money, gets its products to customers, and makes sales. The best places to start are the ones that clearly describe what the company sells, how it interacts with customers, how much it charges, and how it gets its products to people. These details really help us see what the company does and how it makes its money. When it comes to defending against generics, management tends to focus on how to compete and what challenges the industry might bring, rather than diving into the details of the business model itself. This kind of information is really helpful for figuring out how to position your company in the market, but it's not the best starting point for understanding the overall structure of your business. Industry and competitive analysis usually comes after you've already got a good grasp of your business model. Even though understanding generics could impact how you price things or manage risks, it doesn't really give you a clear picture of how your company actually runs or how you make money. A. Incorrect. 10K filings detail products, revenue breakdown, and value drivers, addressing business model questions. C. Incorrect. The investor relations website details distribution structure, support programs, and pricing, crucial for understanding value delivery and capture. Business model determination, focusing on internal commercial choices, underpins analysis of competitive strength, risk, and valuation. Question 4. Revenue analysis. Correct answer, B. To figure out Logi Hub's revenue, we need to remember that the business makes money from two different ways that we need to add together. 1. A commission that's a percentage of the freight's value. 2. A set fee that we get for every shipment. So the revenue isn't just about the total freight value, but rather about the commission part and the fixed fee for each shipment. Platform model revenue breakdown. Commission, 117 million US dollars, and fixed fees, 21.25 million US dollars, totaling 138.25 million US dollars. To get the right revenue picture, it's important to figure out what really drives revenue and how to tell the difference between what the platform makes and what the facilitator keeps. When you're using platforms or commission models, it's especially crucial to clearly separate the value you help create from the value you actually earn. Question 3. Operating profitability and working capital analysis. Correct answer, C. The cash conversion cycle is like a snapshot of how long it takes for a company to turn its money into cash. It starts when you spend cash on inventory and ends when you get paid by customers. Think of it as a way to see how fast a company can turn its investments in inventory and money owed to suppliers back into cash, compared to how long it takes to pay those suppliers. If the cycle is shorter, it means the company is managing its cash better and doesn't need to borrow as much money from outside sources. To really see how these two companies stack up, let's look at the standard metrics. Days sales outstanding tells us how long it takes to get paid after we sell something. Days inventory on hand shows how long we keep our stock before we sell it. Days payable outstanding indicates how long it takes us to pay our suppliers. The cash conversion cycle is calculated as days sales outstanding plus days inventory on hand, minus days payable outstanding. Firm A's negative cycle suggests it gets paid by customers and uses that money to turn inventory into cash before paying its suppliers. This shows it's really good at managing its working capital, with trade payables helping it get the funds it needs. Firm B's longer positive cycle means it takes a bit longer to collect payments, keeps more inventory on hand, and pays its suppliers sooner. Because of this, it might need more money coming in from inside the company or from outside sources. Firm A has a shorter cash conversion cycle, indicating stronger liquidity management in operating efficiency than Firm B. Question 2. Capital investments and capital structure. Correct answer, C. The degree of financial leverage, DFL, tells us how much net income can change when operating income shifts, all thanks to how we're financing things. The degree of operating leverage, DOL, shows how much operating income can change when revenue shifts, depending on whether our costs are mostly fixed or variable. The degree of total leverage, DTL, puts both of these together to give us a complete picture. Asset turnover is a way to see how well our assets are making money. FreshDel DTL equals 3.0 times 1.0 equals 3.0. QuickCard DTL equals 1.75 times 1.2 equals 2.10. FreshDel's higher DFL gives it more earnings boost from using leverage, while QuickCart's slightly higher DOL means its operating earnings are more affected by changes in sales compared to FreshDel's. Since the equity multipliers are the same, the key to comparing ROE is the product of DTL and asset turnover. FreshDel ROE equals 3.0 times 0.70 equals 2.10. QuickCart ROE equals 2.10 times 1.00 equals 2.10. These results match, showing that both companies are equally sensitive to changes in sales when it comes to equity returns. FreshDel makes up for less efficient operations by using more debt, which can boost returns. However, this also means they're more vulnerable to negative outcomes. QuickCart, on the other hand, uses better asset management and a bit more leverage to get the same earnings boost, but they don't need as much debt. A company with a lot of debt might get the same return as a more efficient one, but the risk and how well they manage things will be different. Investors should be careful to tell the difference between getting returns by using leverage and actually improving their performance. A. Incorrect. FreshDel's lower asset turnover removes the potential ROE advantage of high financial leverage. B. Incorrect. QuickCart's more efficient operations are fully countered by its lower financial leverage. Question 1. Correct answer, B. When an analyst starts looking at a company's capital structure and investment choices, it's important to first get a solid grasp of how the company has typically raised money and where that money has been spent in the past. Having the starting point is super important because it sets the stage for understanding all the company's future performance and how much leverage it's using. By looking at how capital has been used in the past, we can see how financing decisions have changed over time, including how much debt, equity, and cash the company makes on its own. Knowing how capital is used helps us understand what the company's leaders are focused on and where they're heading, especially with things like spending on the company, buying other companies, managing the money they have, and giving back to shareholders. This assessment helps us figure out if the company's financing choices have been good for making productive investments and building long-term value. Without knowing this, later calculations like how sensitive the company is to changes in leverage or what its return measures mean won't be as helpful. It's really important to put things in the right order when we're looking at capital structure and investments. First, get a clear picture of how much money the company has raised and how it's been used. Then, take a look at how much leverage the company has and what kind of risk it's taking. Finally, see how well the company is doing and if it's creating value. A. Incorrect. Financial leverage assesses risk based on net income sensitivity to operating income changes, but understanding financing composition and capital decisions is crucial before calculation. C. Incorrect. Return on invested capital, ROIC, assesses value creation by comparing company returns to its cost of capital. Understanding invested capital and its changes over time is crucial for meaningful ROIC analysis.